Hi, everyone. My name is Mona, and I'm the founder of Enzyme Protocol and Avantgarde Finance. So Enzyme was founded in 2016, and we are one of the leading infrastructures in tokenizing financial instruments. The team's around today if you want to chat to them. But actually today I spend most of my time with Avantgarde Finance. And Avantgarde is a vault curator. We focus on helping investors earn yield on their idle crypto assets in DeFi. And we do that by applying traditional portfolio construction and risk management practices on-chain. But today, first of all, I'm very happy to be here. Thanks, Vault Summit, for having us. Today, what I want to talk to you about is I want to challenge a couple of the ideas that we take for granted with DeFi vaults. And then I'm going to show you a couple of case studies that are maybe up for discussion. And we'll conclude by looking at maybe some vault data and ideas that could help further the industry and bring in the next wave of smart capital into vaults. So the two biggest ideas in DeFi that I want to challenge today are, number one, that APY alone is a good indicator of future yield. And I bring this up, I kind of bring it up because it's like pretty much the only metric you see being used in the space when depositors are deciding whether to invest or not. So I want to challenge that. And the other thing that I want to challenge is that vaults are liquid just because it's DeFi. So let's start with APY. So APY is alone not a good indicator of future performance. And the reason for that is because it's taken in a certain point in time, and it's calculated based on a token price at that point in time and a variable, a fixed interest rate for borrowing and lending. But actually, we know that token prices are extremely volatile, especially with yield farming strategies. And we also know that borrowing and lending rates on variable lending protocols are extremely volatile. So that's the first reason. The second reason is that APY, most of the time, completely ignores the idea of total expense ratios. And these are not to be underestimated. They can be extremely high in DeFi. Whether it's impermanent loss, whether it's transaction fees, or whether it's trading slippage, which can get brutal when we have liquidity drying up, like we have in the last few weeks. So here's a chart that we put together to kind of help you visualize one example of this. So this chart shows the current APY since 2020 on three of the largest lending protocols, Aave, Compound, and Maker. And the blue line is the variable APY that we're showing at that point in time. And the purple line is the 1 year forward average yield that you would have achieved had you lent on those protocols at that point in time. So the striking visual here shows, again, backs up the point that APY at that point in time wouldn't have been a great indicator on its own of future yield. And to put it into numbers, if you had used today's APY to predict your future experience in DeFi, on DeFi vaults, then you would have been off by a range of 0 to 13%. And additionally, if you had used APY to predict your future yield, the actual yield would have underperformed half the time and outperformed half the time. So basically, the point I'm trying to make is on its own, APY is not a very helpful metric to decide whether a vault is secure, good to invest in, etc. So we've talked about APY, and I'll come to some things that we can do to improve vault metrics and decision-making around vaults. But now I want to move to the second idea that I want to challenge, which is liquidity. There is this assumption that vaults are liquid in DeFi. And this is not the case. Very often, vault strategies exceed the capacity that they were designed for. And this creates problems because trading liquidity can become an issue when capacity is above where it should be. But it also, as we've seen in the last few weeks, has created some problem on a strategy that has become very popular in the last year, leveraged looping strategies on LSTs, where liquidity dried up for a bunch of different reasons. Therefore, deleveraging in order to fund a redemption became extremely difficult without taking huge losses. And as a result, the only way to deleverage was to use native unstaking and then deleverage. Now, if you're 10 times levered and the exit queue is 40 days, you're looking at 10 times 40 days to process one redemption. So this is a problem, especially when the underlying assumption of people going into these vaults is that these vaults are liquid. So here's a couple of different examples, a couple of charts, which I think are interesting. These are two of the larger Morpho vaults with the curator names anonymized. And the turquoise bars shows the exposure, market exposure vault deposits that exist in these vaults. The purple bars show the available liquidity as of a few days ago. For me, what's very interesting about this is that these vaults are marketed as low-risk vaults, and they actually didn't have any exposure to any of the bad assets on the back of Stream, Elixir, etc. But despite them being low-risk vaults, more than 80% of the positions in these vaults were not liquid. So there is a question, how do we define risk? And I think that the industry needs to think and talk about that a little bit more. I also want to take a moment to just talk a little bit about Stream, Elixir, and events of the last few weeks. There is another issue that arises with vault infrastructure when there is no method to handle a bad position that blows up or defaults in a lot of vault infrastructures. So, for example, with Morpho vaults that were holding Stream Elixir, it was very difficult to, let me start by saying in traditional finance, if a position blows up, what you would typically do is you would either ring fence it and side pocket it so that it doesn't impact the other investors and that everyone takes the loss equally, and or you would gate the fund so that nobody could get out on preferential terms versus the others. In DeFi vault infrastructure, this concept largely doesn't exist yet. And so what happened is after the Stream Elixir event, we saw hundreds of millions removed from vaults at preferential terms before positions got written down, which ironically meant that the last ones in had to wear the loss entirely on themselves, which is really sad because they're often the most loyal and the most loyal investors to the curators, yet they're wearing the entirety of the loss on themselves. So I think, again, this is something that the industry can think about, and this is something that also ties into liquidity and is very relevant to events of the last few weeks. So the key takeaway here is I think liquidity is an overlooked risk metric in DeFi. So we talked about the ideas I want to challenge. The good news is there's lots of very smart people working on solving these problems and increasing transparency and metrics. What smarter metrics would I like to see to further the industry and to give more transparency? So the first one is not necessarily completely ditching APY, but at least realizing we are on chain. Therefore, we have a very strong advantage to be able to provide verifiable, auditable track records so that we can actually judge people based on past performance. And this is much more accurate in past looking than looking at an APY. So I think that's something I would like to see more of. That's something that at Enzyme we've always preferred from day one, but I'm kind of surprised we don't see it more frequently in the industry. The second is the strategy and transparency risk exposure. Actually, ironically, because strategies have become so complex in the last year with cross-chain exposures and lots of leverage, etc., the tooling hasn't actually caught up to provide that kind of transparency. And then additional complexity, some vaults are also doing stuff off-chain, which we have mixed feelings about. But the tooling hasn't really caught up to capture vault exposure when it's doing all of these different and more complex things. The third thing is metrics to measure effective liquidity. I think that that's a metric that depositors, investors would love to know upfront. And lastly, actually related to that also, tools for gating and side pocketing when positions do go wrong. And lastly, some more transparency on total expense ratios. So that if you are using APY as a metric that doesn't include costs, you can also take a more balanced view by looking at how much slippage, cost, transaction fees a vault is incurring. And these can really add up in bad times, even good times. Cool. So in conclusion, APY alone is not a good predictor of future performance. Vaults are not as liquid as you might think. And to grow our industry, I think that we need smarter metrics and further developing tooling. So hopefully this talk has given you some ideas on how we can do that. And yeah, thank you very much for your time. If you guys want to chat later, we're around.